Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Today I'm going to talk about the AI disruption over the last 6 months.
Shall we play a game?
Let's talk about the week that Anthropic tanked the market and pulled ahead of its rivals. Once appeared as an also-ran in the chaotic race for AI supremacy, the sophistication of Anthropic's products upended the stock market. Big global stock sell-off from software to legal services to financial data and even into real estate. Software companies like Salesforce, Workday, Monday.com, Adobe, and Intuit, they've all been following for the last 6 months, but this week has been particularly interesting. But since late 2025, markets have undergone a sharp AI-driven repricing of software, insurance, investment advisory, trucking, and legal service stocks. Software has been hit the hardest. The downturn has continued into 2026 that started in October of 2025, with cloud software stocks starting the year where they left off, in the sell-off mode.
I'm sorry, Dave. I'm afraid I can't do that.
AI competition, particularly new releases from Anthropic and OpenAI, have accelerated the decline. Analysts at Morningstar are arguing that software stocks are now significantly undervalued and that fears of AI disruption are overstated. For long-term investors, this environment resembles past periods of technological disruption, the cloud transition, the 2010s, software as a service re-rating, and even the early 2000s .com unwind. Historically high-quality incumbents with strong distribution, entrenched customer bases, and cash flow resilience have emerged stronger. What's happening? A multi-sector AI-driven repricing. Software stocks have been the worst performers in the S&P 500 this year, with Salesforce, Adobe, and ServiceNow all down 17% or more due to concerns on that AI disruption. Private equity investors have called this an incredible buying opportunity, predicting a wave of mergers and acquisitions as valuations compress. Cluster of declines signal a broad repricing of risk across enterprise software, reflecting investor skepticism. So insurance. AI has underwriting capabilities and automated claims processing that's starting to threaten traditional cost structures. Investors fear margin compression and job displacement. The insurance sector is being repriced as investors weigh whether AI will enhance operational leverage or erode the industry's long-standing structural advantages. Robo-advisors and AI-driven planning tools are raising concerns about fee compression. Human advisor models face long-term competitive pressure. In the world of investment advisory, in trucking, autonomous vehicles are advancing, pressuring trucking and freight brokerage stocks. AI logistics optimizations may reduce the need for traditional dispatch and routing. So investors are discounting the sector ahead of actual disruption, effectively pricing in a long duration risk that may take years to materialize. In legal services, AI legal productivity tools threaten document review, research, drafting workflows. Legal stocks have seen double-digit single-day declines. Why is this all happening? Investors are fearing that AI will cannibalize traditional software. Some of these concerns include AI tools may replace productivity suites. CRM systems could be automated or commoditized. Tax preparation software may face AI-driven alternatives. Cybersecurity monitoring could be increasingly automated. Legal and financial workflows may be streamlined by AI. So there's a collective of all these fears that's starting to represent a thesis that AI will shift value away from traditional software subscriptions and towards more flexible task-based AI agents. Then you also get the Fed rate cut expectations. When interest rates are lower, people pay more of a premium for growth stocks. Right now, investors are rotating out of high growth tech with high valuations. There's contagion across sectors. AI companies are releasing new tools. Investors are fearing incumbents will lose pricing power. Software stocks are falling first, asking questions later. Some historical context is important here. Investors feared on-premise software would die back in 2010, 2014. It was called the cloud panic. Margins are expected to collapse. Incumbents were thought to be structurally disadvantaged. But in hindsight, the period shows how markets often underestimate incumbents' ability to adapt when platforms shift. In 2022, rate-driven tech crash, we saw it. It wasn't that long ago. Rising interest rates crushed high-growth tech multiples. Software valuations fell sharply. Investors rotated into defensive sectors. That didn't last long. And then it created a 2023, 2024, 2025 stock market boom in those growth stocks. We've seen it in the dot-com bust in the 1990s, ending in 2000. Rapid innovation created speculative valuations. Investors feared overinvestment. Winners and losers were quite unclear. Everything went up, everything went down, and then the winners emerged. Take a look at a company like a Google who didn't exist in the late 1990s, how they came out of the dot-com implosion as the winner in search above Yahoo, Excite, Lycos, and others. So Microsoft is a high-quality incumbent being mispriced by AI fears. Investors are worried that AI tools will cannibalize Office subscriptions. Copilot could reduce traditional licensing revenue. Enterprise customers may delay renewals. Competition from Anthropic and OpenAI, as well as Gemini, may intensify. These concerns reflect a belief that Microsoft's productivity moat is narrowing, even though its ecosystem advantages remain substantial. Analysts are saying buy the dip on some software companies. Let me give you an example on Microsoft. It's one of the best positioned AI companies. Office disruption fears are overstated. Azure will benefit from AI workloads. Microsoft's distribution and ecosystem provide defensive strength. So the AI integration at Microsoft, it's a monetization catalyst rather than a threat, suggesting the stock is mispriced right now. Microsoft has a history of overcoming disruption fears. In the 1990s, fear of Netscape and the internet. In the 2000s, fear of Google Docs. 2010s, fear of cloud cannibalization. 2020s, fear of AI replacing Office. I've bought on all of those dips. I've ended up better because of it. AI commoditizes core workflows. That's the big bear case right now. Pricing power will erode in software. Margins can compress. Competition will intensify. Now, the bull case would be that AI enhances existing products. Incumbents have distribution advantages. AI increases software totally addressable markets. Valuations are attractive now versus where they were a month and 6 months ago. What I would expect next is that AI disruption proves slower than feared. Incumbents integrate AI successfully. Valuations recover. Mergers and acquisitions accelerate. What I don't expect is the worst case scenario. It rarely ever is delivered that way. I expect an AI-driven productivity boom across the United States as AI adoption accelerates. For software, the total addressable market should expand. Incumbents will monetize AI at scale. Do I think Microsoft, Salesforce, Adobe, and ServiceNow all lead the next cycle? I can see one or two of them. The AI-driven sell-off since October 2025 reflects a classic market overreaction to technological disruption. While fears, they're not unfounded. The pace of disruption is likely slower and more nuanced than current market pricing suggests. Software, insurance, investment advisory, trucking, legal service stocks have all been hit with the same narrative. It's too broad-based. That narrative is that AI will replace their core revenue models. History suggests that incumbents often adapt quite successfully, and analysts increasingly argue that the sell-off has gone too far. For patient investors, this period may represent a rare opportunity, not the beginning of an AI-driven collapse. I have a big event coming up at the Lafayette Library, Wednesday, March 11th, 6:30 to 8:30. It's called Navigating Wealth in Uncertain Times. Stephanie Richman, Nathan Rogers will be presenting, as will I, Lafayette. Sign up at robblackshow.com. That's robblackshow.com.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.
I got into this industry when GE was hitting its peak after an amazing run of over 30 years. It lost its luster, and it started getting its luster back just recently with healthcare, jet engines, and building of AI infrastructure. Let's talk about GE, Amazon, Microsoft, Alphabet, Tesla, Meta, and Apple. Will they become the next GE? Essentially, they are the big players today, like GE was in the 60s, 70s, 80s, and 90s. When companies become empires, markets get nervous. Every generation has its corporate giants. Companies that are so dominant, so sprawling, so embedded in the economy that people assume they're invincible. In the 1950s through the 1990s, the dominant player was GE. Today, it's Amazon, Microsoft, Apple, Alphabet, Meta, and Tesla. These companies are the GE of the digital age. Wall Street used to punish conglomerates with a conglomerate discount. Today, it's rewarding big tech with a conglomerate premium. The question is, how long does that premium last? And what can investors learn from GE's century-long arc? Let's start this story with GE because it's the story that is a blueprint for what happens when a company becomes bigger than the market can comfortably value. GE's the original American superpower. It wasn't just a company, it was an era. GE built jet engines, power plants, medical imaging, appliances, lighting, GE bulbs, light bulbs, plastics. Financial services came later. It was the Microsoft plus Amazon plus Tesla plus Apple of its time, all rolled into one. Under Jack Welch, GE became the ultimate Wall Street darling. It owned NBC. It owned GE Capital, which was a massive shadow bank that lent money to the people that were buying their products, like jet engines. It owned industrials, healthcare, energy, finance, media, and more. GE was so big that it practically was an index fund. But the 2010s is when there was a slow unraveling. GE Capital blew up in 2008. NBC Universal was sold. Appliances were sold. Lighting was sold. The company eventually split into three separate companies. It went from the most admired company in America to a cautionary tale. It was a company my dad would have liked, you know? He would have thought I was crazy for going after Microsoft and Apple. When companies get too big, markets stop believing they can allocate capital efficiently. That's when conglomerate discount starts to show up. Look at Amazon. It's the closest thing we have to GE today. It's got Amazon Web Services. It's got Prime Video. It's got MGM Studios, Whole Foods, One Medical, Ring, Twitch, Zoox, which is their autonomous vehicles. It's the world's largest e-commerce platform. It's a retailer, a studio, a logistics company, a cloud provider, a healthcare operator, and an AI lab. Let's take a look at Microsoft. It's got Windows, Office, Azure for web services, LinkedIn for social media, Xbox, GitHub, Copilot, enterprise security, cloud infrastructure, and AI supercomputing. It's the GE of software. It's diversified, it's essential, and it's everywhere. Let's take a look at Apple. It's a hardware company, a services company, a payments company, a wearables company, a chip designer, a media company, an ecosystem. It's the most profitable consumer tech conglomerate in history. Next up, Google or Alphabet. They own Google Search, YouTube, Android, Google Cloud, Waymo, DeepMind, Maps, Gmail, Chrome, Pixel, Ads, as they are the world's largest ad platform. They're a search company, an AI lab, an autonomous vehicle company, cloud provider, and media empire. All of those businesses would be multi-billion-dollar franchises, $100 billion franchises. Meta's no difference. It owns Facebook, Instagram, WhatsApp, Messenger, Reels, Quest virtual reality, Llama AI, the world's largest social advertising platform. It's got 3.9 billion monthly users. Tesla, they don't escape my light bulb, if you will, today. It's an EV company, an energy company, a robotics company, an AI company, an autonomy company, a battery manufacturer, a grid storage provider. It's the GE of electrification. So Wall Street is getting nervous. Big tech trades at a premium, but GE once did too. Research affiliates note that old conglomerates trade at a 15% discount. Today's tech giants trade at a 70% premium. That's a massive reversal. Why the premium? Because investors believe that AI is going to supercharge profits. Big tech will win the AI race. Scale is an advantage. That data is a moat. That when you combine cloud with artificial intelligence, it equals unstoppable. So investors are buying into the premium. But I want to throw down some concern. GE looked unstoppable too. When I started, it was tough for me to sell it because clients pushed back. I was like, I got to get into some .com stocks. I got to get into Cisco. I got to get into Microsoft. So the fear that these big tech companies are going to be the next GEs that got too big, we thought it was unstoppable until it wasn't. The fear is that big tech is spending too much on AI, that capital allocation is getting harder, that growth is slowing, competition is rising, regulators are starting to circle, and the valuations may compress. Just go back to Amazon for a quick second and start thinking that they're MGM. They are James Bond. But they're also a web services company. They're also maybe your future doctor replacing the insurance industry. There's a lot going on there. There's the other side of the story, and that's important because GE failed, in my opinion. It had no unifying technology. It had no network effects. It had no recurring revenue. It had no data advantage, and it had no software margins. Big tech is different. These Magnificent Six minus NVIDIA, because NVIDIA is just not as diversified as these guys are. That's the only reason I excluded them. All these companies have 100 million to 3 billion users. They've got recurring subscription revenue. They've got cloud infrastructure. They've got AI models. They've got data moats. They've got a platform lock-in where once you're into this ecosystem, it's tough to get out. And these global systems aren't just in the United States. They're global. G was diversified. Big tech is integrated. That's a huge difference. That's why I'm really circling around Microsoft today and Meta as looking cheap because they've pulled back recently. AI workloads will accelerate Azure growth for Microsoft. Copilot monetization is just beginning. Office disruption fears are overstated. Microsoft has the strongest enterprise distribution in the world. The stock is pricing for far too much fear and not enough AI upside. Microsoft is being treated like GE, but it's executing like Apple. Now, Meta looks great, and Bill Ackman just took a big stake. Reels is crushing it. WhatsApp monetization hasn't even started. Meta's AI models are improving fast. The company is printing cash. The valuation is still reasonable. Meta is the cheapest of the big six on a growth-adjusted basis. I think Bill Ackman's right. Meta is a cash machine with optionality. Your strategy going forward is buy the big six when they're down 10, 20, 30, or 40% because they have massive user bases, enormous total addressable markets, recurring revenue, global ecosystems, AI leverage, strong balance sheets, and durable moats. The big six are not GE. They're the new infrastructure of the global economy. Not all of them are going to be winners. One might fail, maybe two. It's worth thinking about. That's why when these stocks fall, as a long-term investor, I see opportunity, not danger. GE was a conglomerate. Big tech is a platform ecosystem. I got a big event coming up March 11th in Lafayette, at the Lafayette Library. Beyond the Noise, Navigating Wealth in Uncertain Times at 6:30 to 8:30. It is a seminar. Sign up at robblackshow.com.
Visit The Rob Black Show online at robblackshow.com. Listen to archived podcasts, market updates, and information from EP Wealth's certified financial planners online at robblackshow.com.
It's never lost on me that I was born at a great time. As I came of age, the personal computer was dropping from $5,000 to $4,000 to $3,500 to $3,000, all the way to the sub 1,000. The internet took off. 9/11 happened and interest rates went lower. Those low interest rates helped expand multiples for growth stocks as well as create real estate wealth for many. I see that as an investment theme. Let's talk about some investment themes and where we are currently. But let's go back to the roaring 20s. It was the credit boom. There was mass consumerism, easy credit. It was the first modern stock bubble. The 1920s were the first time Americans bought stocks. Radios, automobiles, refrigerators, everything was new. Everything was exciting. Everything was bought on credit. Big winners of that time was General Motors, essentially the Tesla of its time. RCA was a radio for basically was the internet of the 1920s. Montgomery Ward and Sears, they were the Amazon of the mail order era. Losers of that period of time were companies that failed to scale manufacturing, small banks that overlent into the boom. Let's talk about the 1930s, the Great Depression and the Age of Survival. The winners were utilities. People still needed electricity. Coca-Cola, ticker symbol KO. It was a cheap comfort in hard times. Government bonds were the only safe haven for people with money. Losers across the board were banks, industrials, and anything leveraged. Big narrative of the decade was cash is king, debt is death. The 1940s, we saw the war economy. What's that all about? It was industrial mobilization, rationing, and government-directed production. The U.S. government essentially ran the economy. Factories were converted to produce tanks, planes, and ammunition. Winners were Boeing, ticker symbol BA, General Electric, GE, Bethlehem Steel. That was a steel company that was still around in the 1990s when I started investing. Losers were consumer goods companies because of rationing, and luxury brand companies because luxury wasn't a thing that you did. Production won wars, and it created profits. The 1950s, we saw the American century beginning. We saw suburbs, highways, baby boom, and the rise of the middle class. This was one of the most stable, prosperous decades in the U.S. history. Big winners were Ford and GM. Cars became essential, especially when people lived in the suburbs. Procter & Gamble, ticker symbol PG, consumer staples exploded. Early computing company was IBM. Wow. Investing in IBM in the 50s was a great opportunity. Losers included railroads. Cars and planes took over. Other investments like coal started to lose their dominance as oil and gas gained. The 1960s, we saw the Nifty 50 and the electronics boom. Remember I talked about IBM? They started to become a big winner of the Nifty 50. It was like the Magnificent Seven of its age. Growth stocks became religion. The Nifty 50 were the first can't-lose growth stocks. 50 stocks, they included IBM, Xerox, Polaroid, Coca-Cola. Losers were value stocks. Nobody cared about cheap companies. Small caps were being overshadowed by the mega caps. Does this sound like something you've heard recently? The narrative of the 1960s was quality growth is worth any price. Now that belief set the stage for the pain in the 1970s. All that growth led to inflation. There were oil shocks. The inflation wasn't just pure inflation of prices, it was stagflation. As growth slowed and inflation rose. The 1970s also saw the death of the Nifty 50. Now, start thinking about the 1990s when I became an investor and I got into this industry. I was still dealing with clients that were in the Nifty 50 that fell apart and they didn't trust stocks. In the 1970s, inflation averaged 7%, interest rates soared. Stocks went nowhere for a whole decade. Winners were energy stocks like Exxon and Chevron. Gold was the ultimate inflation hedge. Commodities did well. That sounds a lot like what we've seen since 2025 on the stock market. Losers were growth stocks. Valuations collapsed. Bonds were losers as inflation destroyed returns. And consumer discretionary, we couldn't have it all. Inflation eats everything was the narrative. The 1980s, we saw the Wintel era and the age of deregulation. Now, I did a lot of my growing up in the 1980s, finishing high school. So I saw a lot of this. I lived a lot of it. I wasn't paying attention to CNBC. It wasn't around. But I was starting to pay attention to stock charts in the newspaper, which is funny to think about. The Wintel era and the age of deregulation, some big winners because of Wintel. It was Windows plus Intel. They dominated computing, and computing was huge in the 1980s, as was globalization, the PC revolution, and falling interest rates to offset the 1970s where we saw rising interest rates. But the winners in the 1980s were Microsoft. Windows became a global standard. The Rolling Stones licensed their song Start Me Up for Windows 95, which was not quite the 1990s because I'm still in the 80s, stuck in the 80s. Intel was the CPU monopoly because IBM was too lazy to do the CPUs or the software. So therefore, Microsoft and Intel said, we'll do it and we'll become the standard. IBM slipped from relevancy and became a service company, which is important later on in the 2000s. But the 1980s also saw Walmart just do retail disruption. They did it well. They've been around since the 60s, as had Kmart. Kmart did it differently than Walmart. Kmart hired a lot of Yale and Harvard types to run the company and to run their stores, their regions, whereas Walmart did a more of a spoken hub business model that was based on information, early computing power, if you will, made decisions on when people worked, as well as what areas were staffed on what days. People were more likely to buy cat litter on weekends and running shoes on weekends, but maybe they needed something more important like food on weekdays. That's a bad example on Walmart because they didn't really add food till later, but you get the idea. GE was a conglomerate powerhouse in the 1980s. Some losers were like typewriter companies. I went to college in the 1980s with a typewriter, an electric typewriter, where I'd type a whole line, look at it on the screen, and then hit enter, and it would bzzz, print it out. Still made typos. But also losers are like mainframe-only computer makers. Then you saw regulated industries also lose in the world of deregulation. The profits went out. The narrative of the decade was that technology and deregulation will drive endless growth. The 1990s came. It was known as the internet decade, the dot-com mania, globalization, and the birth of modern tech. The 1990s were electric. The internet changed everything. Productivity surged. Markets boomed. I would say the 1990s were dominated by the Clinton era, when the 1980s were dominated by Reagan. And you can see how politics changed both of those eras. Let's talk about what we saw in the 1990s. Cisco, the plumbing of the internet. Microsoft, the Office and Windows dominance. Dell, the PC supply chain king. Amazon, the first great internet retailer. Losers were brick and mortar retailers, telecoms that were overborrowed and over-leveraged to the dot-com build-out of infrastructure, and companies that missed the internet wave. The 2000s saw China commodities in the housing bubble. The 2010s saw the zero interest rate decade, where quantitative easing, smartphones, cloud computing, and Facebook, Amazon, Netflix, Google, and Apple all did well. They were the FANG stocks. Losers were energy, brick and mortar, and value stocks. The 2020s saw AI and inflation's return and the end of free money. Things are moving faster now, in my opinion. AI is reshaping industries at warp speed. Inflation returned for the first time in 40 years. Interest rates normalized. Deglobalization is reversing 30 years of supply chain strategy. Software stocks are being repriced. Winners and losers are shifting faster than at any other time since the 1990s. Winners so far include NVIDIA, Microsoft, Tesla, and chip makers like AMD, Broadcom, and Taiwan Semiconductor. Losers right now include the repricing of software stocks due to AI fears, insurance, legal, advisory stocks, and the long duration. Higher rates are hurting valuations on bonds and other income-type investments. The big lesson is every era has a dominant story until it doesn't. If you look across the century, you see a pattern. The 1920s had credit boom ending in a bust. 1950s saw post-war boom ending in inflation. 1960s growth at any price ending in collapse. 1990s internet mania ending in dot-com crash. 2010 zero rates created inflation and rate shock going forward. 2020's AI boom, where's it going to lead with the repricing of traditional industries? Markets don't reward certainty. They reward adaptation. Over 100 years, the biggest winners weren't the companies with the best technology. They were the companies that adapted. Microsoft adapted from Windows to cloud to AI. Apple adapted from computers to phones to services. Amazon adapted from books to everything. Biggest losers were companies that didn't adapt. Kodak, Sears, Blockbuster, DEC, Digital Equipment, and BlackBerry. Today's AI-driven repricing is just the latest chapter in a century-long story that technology changes, narratives change, winners change, but the market always moves in eras. Are we entering a new one? I think we might. Never be afraid to ask questions. Drive me an email, rob@robblackshow.com.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.
We're all getting older. When I was in college, I decided that I didn't want to work till the day I die. I saw my father work till the day he died. Not quite. He took the last 6 months off to go through the process of dying when he couldn't work anymore. Social Security is something that is there for you and me for now. Financial planners like CFP Chad Burton say don't count on it. That's humbling. The average monthly Social Security check comes in around $2,071. Now, part of my goal of retiring was to have enough money to live off until the day I died. Essentially, I wanted a silly number like $1 million to maybe $40,000 a year until the day I die. That 4% rule was something I was counting on. I don't count on it anymore. Social Security is going to average for now for people who are in retirement $25,000. I couldn't live off that. So a big theme on my show in the last 5 years is once I hit 50, I want to start thinking about income in retirement replacing my W-2. When you're in your 20s, 30s, and 40s, you got a lot of time to earn income, save income, to invest. When you turn 50, that investing conversation changes. In your 30s and 40s, it's about accumulation, growth, risk tolerance, beating benchmarks. In your 50s and 60s, it's about something more practical, replacing that paycheck. I'm going to go over some ETFs and some income ideas. It's not fully fleshed out, but it shows you where I'm thinking. I want you to grow your income as you're approaching retirement from non-W-2 sources. I want you to have exposure to high-quality businesses, tax-efficient diversification, and a structure designed for long-term wealth compounding. If you're heading towards retirement, this segment's for you. We're going to talk a lot about dividend growth ETFs as a starting point for research and or as a point of it's not that bad either as a choice. The concept most investors overlook is total return. Total return equals price appreciation plus dividends. Sometimes you reinvest those dividends. Dividends matter a lot. Consider the S&P 500 ETF Trust, ticker symbol SPY. From January 23rd through April 25, investors who reinvested dividends earned 10.12% annualized return. Investors who did not reinvest their dividends only earned 8.14%. That 2% annual gap compounds dramatically over time. Over 30 years, $10,000 with reinvestment in the S&P 500 is equal to $223,691. But over 30 years, with $10,000 without that reinvestment of the dividends, it's only $124,424. Now imagine combining that compounding engine with companies that raise their dividends every year. Dividend growth is so important after age 50. As you approach retirement, you need stability. You need income growth, inflation protection, lower portfolio volatility, and psychological comfort. I'm going to start with dividend growth ETFs because they check a lot of those boxes. A bond pays fixed income. A dividend growth company raises its payout over time. So if inflation runs at 3% and your dividend growth grows at 6 to 8%, your purchasing power improves. It doesn't erode. Companies that increase dividends consistently tend to be profitable, well-managed, financially disciplined, resilient across economic cycles. When you hear about a dividend achiever for 25 years, it's done it in a good economy and a bad economy. It's done it with Republicans in charge as well as Democrats. Dividend growers historically experience smaller downturns versus broader markets. They tend to lean towards consumer staples, industrials, healthcare, high-quality, large-cap names. Dividend growth ETFs versus high-yield ETFs. High-yield ETFs focus on highest dividend payers, often value-oriented. They can include distressed companies, higher yields, but higher risk. That's not my play. I like the dividend growth ETFs. They focus on companies that increase dividends, often emphasize financial strength. Now, I want to go over some ETFs. And again, I want you to, if ETFs are your thing, that's your thing. If stocks are your thing, that's your thing. But you can take a look at these dividend growth ETFs and find stocks to think about. And you could actually lower your expense ratios because the ETFs have expense ratios. And most of them are teeny tiny small. The first one I want to talk about is Vanguard Dividend Appreciation ETF, ticker symbol VIG. It's got a dividend yield of about 1.6%. It charges you 0.4%, so 4 cents on every $100. What's important to you is the 10-year annualized return of 13.8% plus that dividend yield of 1.6%. To make it into the Vanguard Dividend Appreciation ETF, ticker symbol VIG, you have to have 10 years of consecutive growth of your dividends. They exclude the top 25% highest yielding stocks. They cap holdings at 4%. They exclude real estate investment trusts for tax efficiency. The portfolio is 300 plus stocks. The costs are extremely low and broad diversification. Those are the keys. I want you to look at the iShares Core Dividend Growth ETF. 8 basis points. That's tiny. 10-year annualized return, 14.2%. Ticker symbol is DGRO. Dividend yield of 2.1%. 5 years of consecutive dividend growth. So not quite as stress tested as the Vanguard, which is 10 years. The payout ratio is below 75% of their cash flow. Positive earnings forecast, and they exclude the 10%, the top 10% of highest yielders. Also, I want you to take a look at the ProShares S&P 500 Dividend Aristocrats, ticker symbol NOBL. Noble. Dividend yield of 2.1%. The expense ratio is 35 basis points, so it's not cheap like 8 basis points the iShares Core Dividend Growth ETF is. It's not quite as cheap as the Vanguard Dividend Appreciation, ticker symbol VIG, is at 4 basis points. This one's 35 basis points. So you're going to lose some of your gains for fees, but it has 25 consecutive years of dividend increases. S&P 500 companies only, equal weighted portfolio, 69 holdings. It's a pure dividend growth exposure. This could come as research for you on individual names, and you can cut the cost on the expense ratio. Do you see where I'm going at with that? So I'm not telling you exactly what I'm doing. I own, for instance, I've told you 5 years ago about Caterpillar. It's been an amazing growth company. It's an aristocrat dividend player for 25 years of increasing their dividend. It's been around since I was a little kid. But you can do the individual stocks or you can do the ETFs. It's up to you. If you want a list of ETFs, drop me an email, rob@robblackshow.com. Let's say you're 55 years old. You want to retire at 65. You need to replace $100,000 of income. How much of your income do you want to replace is the big question. I don't think there's a right answer on that. You're going to spend more in your early years of retirement versus your latter years of retirement. But retirement's always going to cost more than you think. Next big event is March 11th, 6:30 to 8:30. Navigating Wealth in Uncertain Times, Lafayette Library. Sign up at robblackshow.com.
For more information about EP Wealth, visit robblack.com. That's robblack.com.